economist Lindsay Piegza. Lindsay, have you had a chance to go through some of these numbers in terms of consumer spending and also business spending in the second quarter in this revision? It coming in at 2%, right in line with expectations.
Well, it is. It's telling a very similar story to what we saw with the initial advanced release of GDP, and that is that the sole organic support to the economy at this point is the consumer. And of course, the concern is then going forward into the second half of the year, will the consumer alone be able to carry the economy? Now, there are some signs that the consumer is still on solid footing as we roll past that June first half break mark, but there are also some red flags surrounding the consumer. If, in fact, we were talking about a particularly strong consumer, what we would see is a simultaneous rise across nearly all key categories of expenditures. And instead, what we're seeing is the consumer very dramatically shift the goods and services in their basket. We would also see a continued upward trend on a monthly basis in terms of that particular discretionary component that we look at in terms of retail sales. But we're seeing a tremendous amount of volatility there. So the consumer right now is still in positive territory, but I don't know if it's going to be enough to support the economy in the second half.
So this is backward looking, of course, but consumer spending in the second report on the second quarter, consumer spending was up 4.7%. The previous was 4.3%. Durables up 13%. Business investment, again, was negative in the first reading, and it held right at a decline of 0.6%. But that was one of the kind of worrisome things. If you look at intellectual property and software, was growth there 3.7%, but that's 1 percentage point lower than it was in the initial report. James, do you have a question for Lindsay?
Yeah, I guess we've been, it's been sort of the story for a while where CEOs are concerned about trade and they're not investing. The consumer is employed and well compensated and spending. I'm wondering if, Lindsay, you took a little comfort from that durable goods order we got earlier this week. After it came out, the Atlanta Fed actually raised slightly its expectations for the third quarter.
Oh, I think you're right. The durable goods report was good. It wasn't great. It doesn't necessarily reinstill confidence that the business community is willing to dramatically loosen those purse strings. We did see a little indication that we're going to see a more positive capital flow as opposed to the second quarter, as Dagan just pointed out, which was net negative to the economy. But really what we're seeing is very specific pockets where businesses are still willing to invest, and that is the area of technology, or as we saw, intellectual property investment. The other areas in terms of equipment, in terms of structure, still very minimal expenditures. Now, of course, when we look at the investment in terms of technology, this is always a double-edged sword. On the one hand, this could help drive higher productivity, which is something that has really been missing from this economy for the better part of the past decade. But also, if we start seeing businesses more dramatically invest in technology, artificial intelligence, automation, this could actually compound some of those negative or some of those downward pressures that we're beginning to see in the labor market, as of course technology can be replacing some of that labor input on that front.
And I'm going to bring Steve Forbes in here, but I want to point out, because in this report we get after-tax corporate profits reported in the GDP report, and in the second quarter they were up 5.1%, which is a rebound from the first quarter. First quarter, those after-tax profits were down 4.1%, so that's a positive sign, Steve.
It is. Lindsay, I'm wondering how important a role, if any, despite all the headlines about the Federal Reserve lowering interest rates, how much of a role is that actually going to play, do you think, for the latter part of the year?
Well, unfortunately, we're already starting from such an extremely low level of rates. So policy arguably was already accommodative. So when we talk about 25 basis points, the market seems to be arguing over such a minimal reduction. I don't think it's going to have a sizable impact in terms of spurring economic growth from an investment or consumption standpoint. I do think, however, that it will help.
Go ahead.
I was just going to say, I do think it'll help, however, confidence. I do think it'll provide additional stability to the market, and it could also help right the yield curve. Of course, we're still seeing that inversion, which sends uncertainty and shockwaves through the marketplace. So more of or I should say, less of a tangible, quantified improvement from further action from the Fed.
So Chairman Powell actually has a point where he says trade, uncertainty about trade matters much more than what they do with a few basis points on interest rates?
I think trade is having a significant impact on the economy, a significant impact on businesses. They don't know the rules of the game. How could you possibly engage in a longer-term investment strategy if you don't know what the world is going to look like 1 week, 1 month, 1 year from now? So I do think that it is causing a tremendous amount of uncertainty and chaos in the business community and even in the consumer community as well. So I do think that the chairman has a point when he says that that is one of the key factors that is impacting the outlook at this point.
And I just want, before we go, Lindsay, I'll just point out that, say, Abercrombie and Fitch is saying additional tariffs on $250 billion worth of Chinese imports and a 15% levy on the rest of tariff goods would impact cost of goods, gross profit by about $6 million for the fall season. So there's A&F shares have fallen 15% year to date. But I'll point something out to be aware of. This is going to be like the weather, that a lot of, particularly retailers, are going to try and blame the trade fight and the tariffs on their own poor business. You'd agree with that. You have to really understand each individual company and business to parse whether what they're telling you is, well, the truth.
Absolutely. And it's also going to depend on the individual company and the sector and whether or not they're able to pass those cost increases onto the consumer. In many cases, the consumer is not on strong enough footing to absorb those cost increases, and they'll be very willing to exchange those goods for other goods. And so we have to be careful about the substitution effect as well. But businesses are going to do their best to try to blame the trade war and pass those costs on to consumers.
Good to see you, Lindsay. Thank you so much. Really a pleasure to see you.